Now, before we start, we'd like to just remind you, please like, share, subscribe. Your support is appreciated. So now when we start going through, and we'll just provide the summary and then we're going to go through the data in more detail. So when we look at the small business optimism, dipped down, expected at 99.5, came in at 98.2. And then the PPI side, everything was right in line, close to estimates. The final demand month over month was expected at 0.6, came in right there. Food and energy, same thing, was expected at 0.5, came in at 0.4. Final demand year over year, 8.6%, came in at 8.6%. So you're still seeing a lot of these pressures on the producer price index. So then when we look at initial jobless claims, it was expected at 260, came in 267, kind of right in line with expectations. Continuing claims slightly ticked up. Again, nothing too concerning. You're going to get some bouncing back and forth. We've had some very good numbers over the last few weeks, so it's not surprising to see a little bit of a pause. CPI is the one that kind of blew through estimates. And again, we've been talking about from all through the end of September into October, inflation was accelerating at the end of September and just went parabolic in October. And that's again, we've been calling for that for months because we saw it building on the rent side, on the renter's equivalent side, on wages. So it's no surprise that you saw that really start to accelerate in October. Now, we have seen some inflationary pressures start to abate in November. So November won't be as aggressive as October, at least so far through November 10th. There's still a lot of pressure on pricing on the consumer, but when you look through the supply chain, when you look at day rates, when you look at container rates, you're starting to see that come down a bit. So again, you have to balance where we sit, and it's going to be difficult to maintain this rate. Like the CPI month over month was expected at 0.6, came in at 0.9. X food and energy was expected at 0.4, came in at 0.6. And then when you look at CPI year over year, was expected at 5.9%, came in at 6.2%. And then the index, again, continues to go up. So as inflation exploded to the upside, real average hourly earnings year over year fell 1.2%. Real average weekly earnings fell 1.6%. But mortgage delinquencies got a bit better. But the real average earnings is going to be a problem because that's when you start looking at consumer confidence. Consumer confidence has come down. Their concern on their financial situation continues to worsen, which again is just going to make them pull back. And as they pull back, is it going to be now? Is it going to be when they get their heating bill based on how big their heating bill is going to be? That's going to be, I think, a much bigger thing to look at. As wholesale inventories went from was expected at 1.1%, came in at 1.4. Because remember, as we've been talking about, inventories will be a little bit of that bright spot as companies try to pick and choose how they try to rebuild and create some sort of continuity in their supply chain going forward. So then when we look at the U.S. CPI, it's not funny, but it's funny because I think this was probably one of the easiest things to predict back in 2020, even though I got nothing but hate for it. And then when I put out that article in February looking at it, be like, no, inflation's everywhere. It's not being picked up. And then a Bloomberg personality told me that I was just looking at cost and not price. But again, cost, you assemble cost as a company to figure out your price. So clearly there is a backdrop there. So much hotter. October CPI, again, as we said, was expected at 0.6, came in at 0.9. And this just shows you where we sit. So annual growth now highest since early 1990s. As you can see that we are right back to where we were at that peak on the consumer side. Again, just the amount of pressure that we continue to see in the system. But where is the backdrop? So there's no doubt that inflation when you look at the inflationary pressure, and this is why we talk about wages so much, because wage rates are going to have to continue to go up in order to keep pace where inflation is. So wages are so far below inflation that they're going to have to accelerate and not only try to make up their difference, but go above it and go faster. And then you get the circular move, which we've seen previously, which we saw in the 70s, which is why inflation, once out of control, gets very hard to pull it back into the bag. Like once the cat is out of the bag, good luck trying to get it back in. And this is just one of those key examples when you look at the inflationary pressures. Now, the important side, when you look at how we've gotten here, here's where you can see where that wage growth is and how it's so negative versus this previous period. Now, we know nominal wages are going up, but they're just not going up with inflation. If not, inflation is already surpassing them, which means that wages are going to have to go up more, which then if wages go up more, that means companies' costs go up. So as costs go up, the price of the goods goes up, and then inflation goes up again. And then you get, again, that cyclical connection. So this is just looking at a Bloomberg estimate, and I thought it was an interesting look because when you look at supply, so as Bloomberg economic forecast model shows, sustained shortages could keep U.S. CPI around 5%. So if you have supply constraints, depending on when they alleviate, that's going to become the much bigger issue. So consensus forecast has that drop. I'm speaking from someone from a perspective that I look at the supply chain daily. It's my job. And none of these constraints have really abated. You've had prices get better. You have some containers move, but there are still so many issues that remain through the system. It is unlikely to start to see this get any better before Q2 of 2022, which again is going to keep inflation pinned at the highs, which is why consensus is going to continue to come up, which should put additional pressure on the underlying growth profile of the underlying economy. And then what are some of the contributions? So when you look at the contributions, a lot was made that, that's all reopening. After we're done reopening, everything will be fine. Well, we've reopened and we're still not fine. And when you look at some of the things, so you had used cars actually go back up. Some of that should start to get better as the supply lines get a bit better. Toyota and Nissan have talked about it. Energy continues to be an issue. And remember, we still haven't even had a mark to market yet for some electricity prices, for heating oil. Like, how have people gotten their new contracts? Have they gotten their first shipment? Like, these are things that are going to continue to be there. But the all other CPI components is the key, where you can see how slow it was, and then it continued to accelerate. And now those all other components, the sticky ones, are now becoming a much bigger and bigger part of it, which is where we see that overhang. And if we translate this to the PC inflation, which is the gauge that the Fed prefers, we're at about 5% on a 12-month basis. And then energy prices obviously surged 4.8%. We expect this to be a bit of the peak. We don't expect gasoline prices to go above $3.41, as we talked about in the EIA show. I do agree with Gas Buddy on their view that we will see a bit of a pullback closer to that $3.37. And then, but the supply chain bottlenecks, core good prices rose 1%. And then the price increase in services categories are also broad-based, suggesting that the labor shortages and rapid wage growth may be seeping into consumer prices, which we know. But even with that wage growth, it's not keeping pace with where inflation is right now. And then shelter prices also increased 0.5%. As we've said, that's not going away. That's only going to get worse. While reopening categories were mixed, with gains in autos and hotels and restaurants, but a decline in airfare. So again, there's still something to be said. So when you talk about people who are still thinking about this on a transitory level, you could say, like when you look at energy, cars, that is something, but services role in the pickup shows others will continue. And that's where the transitory comment kind of falls apart. Higher inflation expectations could also mean that even if Team Transitory is correct, that headline inflation will fall, core prices may still run higher. So again, just because, and this is what we look at, the pace of increases. We expected the pace of increases to ramp in October. And now we expect the pace of increases to slow in November. So again, you're going to see some of that slowing, but it's still going to be there because of that core goods, because of that really driving force higher. And this is just breaking it down a bit better. When you look at services X food and energy, goods X food and energy, those two things continue to surge up. And that is not a reopening thing. That is not a shortage side where, yes, there's shortage, but there's a shortage in inventory. So you're going to have to rebuild inventory. There's a whole problem that, again, when you think about how this is such a knock-on effect, or that butterfly effect as we described in segment 1 continues to play out, that will keep us at this elevated level. And then when you look at the median PCE deflator excluding shelter, the underlying trend is now above 2.5% and heading higher. And as we've been talking about using the Fed dashboard, the Atlanta Fed dashboard, it's all getting pulled up. The rate of change is the only thing that adjusts based on, is it sticky? Is it a long-term look? What is the time frame? But all of it is pulling up and higher. Now, adjusted for inflation, worker compensation is lower than it was before the pandemic, which again leads to how much available cash is there to spend when you think about where prices are, how savings have been drawn down, and how things are going to play out with the drop in government transfers. And then this is just looking at retail prices. That's select sirloin steaks, bacon, ground chuck, boneless. So all of these have been driving higher, but they've been driving up even before we got to this point. It's just a matter of where things continue to push, putting pressure on people's balance sheets. Because if you think about a restaurant has a markup. So they're going to buy these pieces and they're going to increase their prices. But if you eat at home, your prices are going up. And that's that pressure point when we look at how household consumption is going to look. And then when you look at the average price paid for a new car in the US, you get an idea of by month, and then the 12-month average. Going back to 2011, we started just below 30,000, and now we are sitting here at just over 40, and then on a month at 42.9. So when you annualize that change in car prices, you get an idea of just how insane these prices have gone and where we continue to see these pressure points. Now, household debt holdings at all-time lows. So when you think about the total financial assets, everybody's piled into equities. Well, and why? Because why would you own debt? Debt is not even carrying inflation. So that's where, if you want to see people cycle out of equity and into out of equity into debt, you're going to have to increase rates. That's going to draw additional consumers to it, and that's how you get some of the cycle. But you get an idea of just how offsides everything is due to low rates, due to the move to more riskier assets, if you will. So the inflation eroding real incomes is the biggest decline in over 40 years. And if you look back to the 1980s and you think about what happened there, how it was stopped, it was with raising rates, and that is becoming a much bigger problem when you look at the inflation-adjusted median weekly earnings. Again, just the amount of pain that is being realized at the consumption level. But and how do you offset it? You raise wages. And this is giving you an idea of private industry worker compensation. You get an idea of just how big that increases in finance and insurance, in admin supply chain. You're just seeing how the pressure remains across the system for both goods and services as they try to pass on and increase that compensation. So now when we look at producer price index, you're excuse me, you get an idea of where final demand is. So the pace has slowed a bit on PPI, but it's still elevated. And what we've been talking about is you're not going to get this massive rollover. You're going to get the pause. And that's when you start getting into that stagflation, where we still don't have these prices fully passed on. We don't even know if all of the prices can be passed on, but the pressure is there to try to move that all the way through the system, which is where you start looking at PPI materials and components for manufacturing, surging to those highs, percent change, still elevated, still at the highs going back to 2000. And then and that impacts small businesses. So small business job openings, hard to fill, starting to come down a bit. You're starting to get, obviously, people come back to work. As we've talked about in our last shows, you had long-term unemployed coming back. You're starting to see some of that come down. And because of it, hiring plans are starting to slow. Still elevated, still a lot of hiring, but you're starting to see a little bit of a calm down in terms of the ability to find jobs. But when you think about companies going forward, when you look at the margin 12-month forward and the small business optimism minus planned wage increases, you get an idea of just how just how big that drop is, and just where we are on actual earnings changes on the small business side, continuing to move lower. Again, just putting pressure on why own equities at this point in time outside of trying to own the riskier asset. B of A, something similar. When you look at global EPS model, predicts a deceleration. You're starting to see some of that come back down. But right now, the spread between price versus labor mentions also reaccelerated, pointing to continued margin strength because prices are still going up. You still haven't reached a point where the consumer is like, no, not doing it. I can't do it. I'm done. So there is a bit more along the lines of kind of where is this going to go, which is why we talk about EPS and the go forward rate. So then when we turn to and look at optimism, you can see that the optimism index continued to weaken, still off the lows from pre-pandemic, but outlook for general business conditions is at the lowest level since 2012. So you're seeing the future is weakening. So small business optimism fell to 98.2. 31% see increased CapEx, 53% anticipate higher selling prices. Net expecting better economy fell to negative 37%, which is again the worst since November 2012. Inflation, single most important problem, is spiking again as CapEx plans continue to increase. Again, increase wages, increase the need to go and buy inventory. Business compensation index surging to the series high. And then compensation plans continue to surge to the high, again, trying to pull people back and marry with where inflation is going. And that's as you push through wage increases, you increase price plans, and small business price plans continue to surge up. So then when you look at small business outlook for general business conditions, continuing to go to the lows as companies are concerned about where the future is, and poor sales, single most important problem is continuing to become again, it's not the problem, it's just the wages, it's where things are sitting overall. So then when we look at where inflation expectations continue to go to, this is looking at the median 1 and 3 year. You can see they continue to get pulled up. Median 1 year ahead expected inflation rates continuing to move under 50,000. And again, people who are at the lowest end of the income stream are seeing the most impact, which again leads to where they think inflation is going to go and the pain that they're seeing, which is why when you look at the 1 year ahead earnings growth expectations, starting to see that flatten out as the 1 year ahead household income growth expectations also flatline. Again, meaning with where are things going, how does this look? And we expect this to continue to roll over on the income growth expectations as real wages just really aren't able to keep up with expectations and with inflation. So again, a lot of these key areas that we continue to look at. So now that we went through the inflation side and the supply side, now we want to look at demand and the consumer to look at how is that going to play out over the next few months.